Something changes when you hit $250,000 in savings. It's not a number that makes you rich, but it's the point where money starts working differently. Up until that moment, most people are in building mode, saving a little here and there, trying to stay consistent, and often feeling like they're making no progress. But once your balance crosses $250,000, the math begins to favor you instead of the other way around. That's because at $250,000, your money finally has enough weight to grow meaningfully on its own.
The compounding you've heard about your whole life starts becoming visible. 5% annual return on that amount is $12,500 a year. That's more than $1,000 a month just from your money sitting there and earning returns. The same rate on $10,000 would barely get you $500 a year. The gap between those two isn't luck, it's scale. This is the level where growth starts to pick up momentum. For most people, reaching this number doesn't happen overnight. It comes after years of earning, saving, and learning to manage expenses. But when you get there, something else happens. Your mindset about money starts to shift. You stop thinking only about saving, and you start thinking about managing wealth. You begin to see your money as a tool instead of just a safety net. That mental shift is one of the biggest differences between people who stay comfortable and those who continue to grow financially. At this point, your options multiply. If your money is in a high-yield savings account, it's earning a few thousand a year in interest. But many start exploring other paths, investing in index funds, dividend-paying stocks, or even low-risk real estate opportunities. The difference between earning 1% and 6% on $250,000 isn't small anymore. It's the difference between $2,500 and $15,000 per year. That extra return could fund investments, cover expenses, or grow your balance even faster. According to the 2024 Federal Reserve Survey of Consumer Finances, the median net worth of American households between ages 35 and 44 is about $135,000. That means if you've reached $250,000, you're already ahead of most people in your age group. It's not a bragging point, it's a signal that your financial habits are working. At this stage, the goal isn't to change everything, but to make your money more productive. Something subtle also happens to your sense of financial security. When you have $5,000 saved, every unexpected bill feels like a threat. At $50,000, it's a little better, but you still think about the next paycheck. At $250,000, you stop worrying about emergencies the same way. You could lose your job and still have months, maybe even years of living expenses covered. You could handle a car repair, medical bill, or short-term setback without stress. That peace of mind doesn't just feel good, it allows you to make better decisions. You stop acting out of fear and start acting from strategy. It's also the point where you start to understand how leverage works, not in the risky way, but in the intelligent sense. You realize that your money can buy you time, flexibility, and better opportunities. You can invest in learning new skills, take time off to think, or explore better ways to grow your income. $250,000 gives you breathing room, and breathing room is what most people never get. But it's also where mistakes can be costly. The temptation to overspend, upgrade your lifestyle, or chase higher returns is strong. Many people who reach this point lose discipline and start to believe they're financially untouchable, but $250,000 is still early-stage wealth. It's strong, but not unbreakable. The key difference between people who double it and those who lose it is how they treat it. The smart ones stay steady, continue saving, and resist lifestyle inflation. They understand that wealth compounds best when it's left alone. At this level, diversification becomes important. You don't want all your money sitting in one account or asset. Some people keep a portion in cash for liquidity, another in index funds for steady growth, and maybe a slice in bonds or real estate for balance. The goal isn't to chase big wins, it's to protect and grow consistently. When you've built a foundation like this, the game shifts from how can I get more to how can I make sure I don't lose what I've built. There's also a noticeable shift in how you think about work. With $250,000 saved, you realize you have options. You're no longer stuck in a job out of desperation. You might stay for passion or purpose, but not out of fear. you have what's called financial optionality. That doesn't mean you can retire yet, but it does mean you can walk away from things that don't serve you. You can take a career risk, start a side project, or even switch industries without panic. That sense of control is something money quietly buys long before it ever makes you rich. From here, your progress accelerates faster than before. It's easier to save when you already have money. The interest, dividends, and growth begin to contribute meaningfully to your yearly increase. For example, if you keep adding $1,000 a month to your portfolio while earning a 6% annual return, your $250,000 could turn into over $500,000 in about 8 years. Even if you don't raise your contributions, the compounding curve starts steepening and growth feels easier than the early years of saving. At the same time, your relationship with risk starts to mature. When you first start investing, small losses feel painful. But once you have experience and a cushion, you stop reacting emotionally to every dip. You start thinking in decades instead of days. That patience is what allows compounding to actually work. You understand that markets fluctuate, but time smooths the curve. This is where you stop being a saver and start becoming an investor. It's also common for people at this stage to become more strategic about taxes. When you're earning and investing larger amounts, tax efficiency matters. That's when you start paying attention to retirement accounts, capital gains, and portfolio balance. According to Fidelity's 2025 investor report, optimizing investment accounts for taxes can increase net returns by up to 1% or 2% annually, and at $250,000, that's an extra $2,500 to $5,000 a year just from smarter planning. It's a reminder that managing money is not only about earning, but about keeping more of what you make. Another unexpected effect of reaching $250,000 is that you stop chasing every new opportunity. You start valuing stability. When you have less, it's easy to get pulled into risky trends, crypto booms, day trading, or flashy investments promising quick returns. But once you've built something real, you see through the noise. You begin to prefer boring consistency over excitement. You realize wealth is built through patience, not luck. You also start seeing the compounding effect outside of money in habits, health, and knowledge. Because you're no longer stressed about basic survival, your mind opens up. You can plan better, think longer term, and make choices that improve your future. Money gives you the space to act deliberately instead of reactively. That's something no one tells you about financial stability. It doesn't just change your bank balance, it changes how you think. Eventually, what starts as $250,000 turns into something much bigger if you stay consistent. At a moderate 6% growth rate, that number could reach $500,000 in just over a decade, even with minimal contributions. From there, it becomes easier to generate reliable income streams, enough to cover major expenses or even replace part of your paycheck. That's how real financial independence begins. Not from hitting a lottery number, but from disciplined growth over time. When you look back, the hardest part was getting started. Saving that first $10,000, then $50,000, then $100,000. But once you reach $250,000, the feeling of uphill struggle fades. Your money begins to carry its own weight. You finally reach a stage where effort and results feel connected, and that's when everything starts to make sense. Wealth stops being a mystery and starts being math. The takeaway is simple. Hitting $250,000 in savings doesn't make you rich, but it puts you in control. It's the stage where compounding, discipline, and time start working in your favor. The key from here isn't to change strategies. It's to keep doing what got you here, but with more intention. Protect your capital, stay invested, and let time do the heavy lifting.